What's up, guys? Mr. Second Passport here. Today, I'm going to cover the last installment of a quick series I started here a little while ago. 5 ways that I currently use to generate passive income while I live abroad. Now, I know passive income it can be very misleading when you see it online a lot of times. Anything real estate related, I can be the first to attest that it is anything but passive when people say that. It's not, right? But the 5 that I'm going to cover, that I've already covered 3 ways, are truly passive, meaning they require little to no effort on your part. So, I mean, something to think about, like just a quick recap. I'll do this really quick today. If you'd like further details, stay tuned to this channel. My particular favorite is the last one I'm going to cover today in this video. But I'm just going to cover very basic, why I like it and how much you can make. If you want more details, stay tuned to this channel. And you can also research on your own. There's a bunch of information online about it if you're interested. So, the first thing I covered was foreign currency CDs in a place like Everbank that allows you to have them. It's an FDIC insured bank out of Florida that allows you to have, Brazilian real, Mexican peso, or Euro CDs or whatever, paying their respective interest rates. The number 2 was local Ecuadorian CDs, which are currently paying around 8% a year. You want to be careful not to go over the insured rates on those because you never know. Number 3 would be, number 3 was FHA loans, which pay usually a spread over the current treasury rate. I've been getting 6.5% on those for the last couple years now, annual, right? And they're not federally backed, but they are assumed to be, right? In the case of a crisis, I mean, it's a federal agency, it's a federal plan, so you would assume that they would help out if there was ever an issue, right? 2008 style. And then number 4 here, I'll cover real quick, are just simply long-term treasuries, like even. You can get zeros still for close to 5% still. They were over 5% a month or two ago. 5.2 I saw, 5.3. Now they're down to about 4.85% on a 20-year. But still, it's still the best rates you've seen in the last decade. So why not take advantage and lock that in, right? And go from there, right? And people think it's not liquid, but actually they are. If you can actually, they're not as liquid as short-term treasuries, but they are. You can still unload them in a matter of maybe 5-10 minutes. Find a buyer for them if you ever needed to through a brokerage like E-Trade that offers them, right? So something to think about as well. It's not like you have to hold it for 20 years, and if there is rate depreciation, then the price of yours with the higher interest rate will appreciate, giving you also a capital appreciation as well. So something to think about. Number 5 here is my current favorite for passive income. Now, this does require about 5 minutes a week as far as actual work, but that's about it. You could do less than that too by selling longer dated, but it's covered calls, right? So basically, you need a brokerage account, one that will help you, that will allow you to buy and sell options, and you pick the security, right? Whatever you like. You like the stock market, you sell against the SPY, the S&P 500. You like dividend stocks, you like gold, you like silver, maybe a specific commodity, you like oil, you like Bitcoin, you have the IBIT. So basically all you need to do is find an ETF that tracks the type of security that you like, that you think is going to appreciate over time, right? The best based off its current price. And so for me, like the TLT, I think is a pretty interesting play right now, which is an ETF that tracks the long-term treasury market, right, and long-term bond market. So, you want to find something that you don't think has a lot of downside, because when you hold something, if it goes down, then you're going to ride that sucker down. And basically what you're doing is you're holding a security, which you would anyway, is the idea, and then you're selling covered calls against it, which you're selling it to people who are maybe shorting what you're holding, and they want to cover themselves, so they're buying a type of insurance, and they pay you a premium, right? And you get to pocket that premium, every week if you sell weeklies, or every month if you sell those, or every quarter if you sell those, or every year if you sell annual, right? So again, something to think about. And another thing I like that I won't get into much this video is, you can have a security, sell covered calls against it to get, that weekly income or monthly income. And then against that money in your account, you can also, like I put here in black, sell option spreads, right? And you can focus on only selling the ones that where you're the house, basically, not the player. And you have a mathematical chance of like 98, 99% win rate, right? You can focus on those and forget all the others, right? So you can sell what you want. And so based off the money in your account, usually a brokerage will give you also a non-marginable allowance that you can also use to sell spreads with and make more money, right? And you control, right? You control the odds, more odds in your favor, less premium you'll make, et cetera, depending on how sure you are of something. But again, it's just even more income that you could be making, right, on a weekly, monthly, or yearly basis. So the TLT, if we look at it here, why do I like it? Basically, at the current time, you can see it's established a pretty nice floor here over the last year and a half of around 80 to 90 bucks. It just broke through 90 yesterday. Big move up, and it was up around 175 in COVID time. And if you look at the 20-year chart, you can see it's something that's trending up over time, slowly but surely, even though it pays a nice dividend. But it does spike up sometimes when the market crashes, but it's established a pretty nice floor here. It dropped like hell when the Fed started to raise interest rates in 2022, but it's established a pretty nice floor. I don't think it has a lot of downside at this level, so that's why it was, it's kind of interesting for this strategy. To give you an idea, but you can sell these options against any security you own or want, right? That has an options chain, right? That's all you have to do is look. This is on Yahoo Finance. You can see real quick. So to give you a real quick example of how much you can make from this strategy, so like the current closing price was at $90.62 a share. The closest at the money strike price was $90.50, and the premium for the week out call was 64 cents a share. So it has a baked in intrinsic value, the difference between the current price and the strike price of 12 cents. So you're looking at a 52-cent premium. That's money that you make, in your pocket, in this case, every week, in this case for this week, based off the current volatility. Now, these numbers and premiums offered do change based on volatility, so you won't get that every week, but you could assume something relatively close to that. And, how much would you need, to have in this in order to make a decent income? So, like one options contract, if you were to sell it, you'd make, because option contracts are sold in lots of 100 shares, so you'd make 52 cents times 100, you'd make $52, right, off that. Now, if you were to sell 10 contracts a week off this security, that would be $520 a week times 52 weeks a year. You would get, obviously, roughly $27,000 off that original, $90,000 that you would need in this particular security, right? TLT. So, again, you can sell against any security you want. I'm not giving advice in any way. Just do what you want, but it's just an interesting way to make a steady income. So, $27,000 off the $90,000 And how do I get it 90,000? Well, that's 10 contracts that you'd have to sell each week at $52 a premium each contract at the money. And to have the money in your account in that security, and to be able to sell the contract, you would need 100 shares, right? $9,000 times 10 contracts, $90,000, right? That's how much you'd need in order to sell 10 covered calls, say on a weekly basis. And you would generate roughly a 30% return plus the dividend that you're making from holding that security. In this case, it pays a dividend, 4.4%. Roughly 35% is what you would make, right, annual. Now, it won't be exactly this because, as I mentioned before, the volatility changes each week, the premiums that you'd make. But it's just something interesting to think about, right? And real quick here, if we look at this, right, and if we look at this and just real quick here, right, if we look at the risk, right, what happens when in this case, the stock holds where it is for the week? Doesn't go up, doesn't go down. Well, you would make that premium, right, if the stock were to hold. That's really the best case scenario. You want to find things that you don't think are too volatile one way or the other, which is why a bond ETF might make sense for you. I don't know. It depends what your personal views are. Because you would make that premium. You'd pocket that premium, say the price held exactly where it is, and that call you sold a week from now would no longer be worth $64 on one contract. It would be worth $12. That's the intrinsic value difference between the current price and the strike price. So now you just simply buy that back. What you were sold for $64, now you'd buy it back for $12. You'd make the difference $52, right, for that week. Times 10, $520. Now, what if the stock were to fall, right? What if the stock were to fall? Well, you would still make that premium, and we're assuming, right? So you'd still make the premium, and you would take a hit on your account. That's why you always want to do this strategy on a security that you like, that hopefully you would buy more of if the price were to fall, and you wouldn't freak out and sell out of if the price were to fall, right? It's something you still plan on holding for the long term. So if the price were to fall, you'd still make the premium, but your account would go down because the price of that underlying asset went down as well. But it wouldn't go down as much as if you just held it outright, because you'd still make that premium, that weekly premium that you sold for. Now, if the price were to go up, well, again, you'd make the premium, and you'd have that underlying asset which appreciates with the price, right? But you would miss out on the gain, on any gain. You'd make just the premium, but you would miss out on the gain if you sold a call at the money. So the asset you were holding actually went up, but the call that you sold caps your upside, and you would miss out on that gain. You wouldn't lose money, but you'd miss out on the gain. And in order to keep the thing going, you'd have to roll the call out. Again, I don't want to get too detailed in this video to kind of keep it brief. You'd have to roll it out for another week, right, to make another premium again. Or you'd actually have to take cash out of your account and buy back in, right? Buy it back so that you can sell another call the next week. But the account balance in your account, if you follow me here, doesn't actually go down in this case because the underlying asset has appreciated as well. So you'd miss out on the gain if the price goes up, but you would not lose money, right? So again, in all three instances, you're making the premium, which is what we're getting at here. It's the you could say income that this strategy is very interesting for. So again, something to think about. These are my quick 5 ways that that I currently generate passive income that you could as well if it interested you. You definitely need to learn more before you get started. And what's nice about this is you control the risk. You don't have to sell at the money and get the max premium each week. You can sell way out of the money. It kind of depends on the strategy ideal for you. You can sell out of the money, make less premium, but you can also participate in more of the upside. You could also sell what I like in the money at calls and protect yourself more against any downside that week. And so you're making a premium when you're in the money, but you're also protecting against downside. So again, you kind of have to, play with this a little bit and see what works for you, what security you like, what works for you. And hey, it's a way that I'm surprised isn't mentioned more online as far as a way of generating a form of steady income, right? Not necessarily steady numbers-wise, but steady nonetheless. Anyway, I'm Mr. Second Passport. If you like this and would like to see more topics like this and to go deeper in depth on this specific topic of selling covered calls, then just make sure you click the like button and subscribe to this channel. Be notified of future videos that will, a few of them will cover this topic, as well as living